Some interesting signals were sent by this business in Q3. The first signal is share buybacks. They just bought back the most shares in their company's history, 1.2 billion worth. The second signal is insider buying. The CEO himself bought 12,400 shares on July 24th. Insider selling can be for a host of reasons. Insider buying is for one reason only. Oh, and this is after the same CEO bought 5,300 shares 5 months earlier on February 24th. With these signals, MSCI is telling investors we are undervalued. But are they? What does their latest earnings release tell us? Welcome to the Quality Investor. After their earnings release before trading opened up, the market certainly responded to these signals, especially the buyback signal, as shares popped 8.6% on mostly positive earnings. However, the day after, shares have come back down a little bit, over 4% down so far on the day. A major theme of MSCI earnings from the previous quarter was the retention rate. The market reacted with disgust to MSCI's second quarter earnings by dropping them 8.9%, due mostly to a slight decline in quarter-over-quarter retention rate. The Q2 retention rate was at 94.4%, down from 95.3% in Q1. Check out that video linked in the description for a deeper explanation. This quarter, the retention rate bounced back to 94.7%, up 30 basis points quarter over quarter, and up 50 basis points from 94.2% year over year. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. MSCI is back in favor now, and there were other things to like in the earnings. Aside from the massive buyback, MSCI announced an additional $3 billion share buyback as well, sending another signal to the market that MSCI continues to be attractive. But what really makes MSCI such a quality business is its recurring subscription revenue. The recurring subscription run rate grew 7.4% year over year in Q3. And while that is not explosive growth, it is consistent growth and underscores the reason why I believe MSCI is such a high quality business. Its sustainable economic moat. Margins, an effective quantitative indicator of moat strength, continue to rise. Their moat is driven by strong switching costs and a network effect. Clients face significant barriers to switching providers because MSCI's tools and indexes are mission critical for investment decisions, portfolio benchmarking, and performance tracking. Asset managers and ETFs built around MSCI indexes would incur high costs in retooling, renegotiating contracts, and retraining staff if they switched. This stickiness supports the strong retention rates, around 94 to 95%, and pricing power, allowing MSCI to raise fees annually without much churn. As for their network effect, the more funds benchmarked to MSCI indexes, the more valuable they become as an industry standard. This cycle reinforces itself. Greater adoption attracts more users, reinforcing MSCI's dominance. For instance, MSCI captured a significant share of ETF inflows, and its indexes are embedded in the global financial ecosystem, making it nearly irreplaceable for many institutions. So, let's review their earnings report, assess their outlook, and finally, provide what I believe is the appropriate buy price for this wonderful business. MSCI closed out the day after their earnings at $567.54. They opened the day at $588 and just declined sharply right away before trading pretty much flat the rest of the day. Now, this comes after the day of the release of their earnings, where they shot up 8.9%, like I mentioned earlier, on the day. So they shot up the day of their earnings and then promptly fell down about just over 4% the day after. But all in all, they have had a positive bump due to their earnings. MSCI's operating revenues were at $793 million for the quarter, and that's up from $724 million in the same quarter last year, a 9.5% increase. And that's the thing that we see with MSCI. They're a remarkably consistent business On the year, revenue-wise, they are up 9.4%. It's a bit of a slowdown from their fiscal year 2024 year-end growth, probably contributing to some of the more mixed reaction by the market here. But we also have operating margin expansion, 56.4%, up from 55.4% a year ago. And year-to-date, 54.1% operating margin, also up from the same 9 months ended a year ago at 53.2%. The margin expansion that we're seeing here can be attributed to this right here. Asset-based fees are up 17.1%. So MSCI, they charge asset fees based on the total number of assets that they manage. It's a percentage of that. And they saw remarkable growth this quarter, and I'll show you that in a second, of their total assets under management and their ETF products. And actually much of that is attributed to growth in the market. So in Q3, the S&P 500 actually saw some pretty decent growth, up 8.4% for that quarter. And if you look at the year to date at the quarter end at 9/30, the S&P was up 13.7%. So over half the S&P's growth this year came in just that quarter. And we're definitely seeing that MSCI is benefiting from that. They posted strong net income again, and really earnings per share at $4.25, up 19% year over year from $3.57 a year ago. And a lot of that has to do with their massive buybacks that they did. Of course, that's going to inflate the per share basis for investors. But a strong argument can be made that MSCI was undervalued much of the quarter, and management repurchasing shares with the free cash flow is probably a good decision from a capital allocation perspective. An important metric that MSCI uses to measure performance, as well as investors to track growth, is this run rate, which is basically the annualized amount of all their current recurring subscription revenue. So if they were to take all the current subscriptions they have today and they managed to annualize that and recognize all of those revenues, they would have about $3.2 billion, well, really $3.187 billion in total revenue. And that's a 10% growth over the prior quarter from last year, from $2.894 billion. So pretty solid growth there. And if we look at that 94.7% retention rate, MSCI can expect to actually realize about $3.03 billion of the $3.2 billion run rate. Here is a breakdown of their operating revenues by their segment. The index segment did have the largest jump, and that is MSCI's core business, creating these indexes, and then they have ETFs that are linked to these MSCI indexes, which generate these asset-based fees. You can see that big jump here, 168.6 million a year ago to 197.5 million this year, which is a 17% jump, and index as a whole grew 11%. So it is good to see their core business growing fast. Although sustainability and climate did slow down in growth a little bit, only 8% growth year over year. This is expected to be a high growth segment for MSCI. So we need to see this number get back up to at least 15 to 20% to really see the market respond and start giving MSCI that high premium in the market that they used to have maybe a couple of years ago. And this is what I was talking about, which was driving assets under management, market changes really. Q3 2025 quarter over quarter AUM drivers. You can see here, if you look at the Q2 2025 ending, $2 billion. It's now at 2.2 billion. And a large driver for that is market changes. So we see $140 million increase due to the market change. So favorable market conditions are driving assets under management up. They had net cash inflows of 46.4 billion. And even on a year-to-date basis, assets under management is really being driven by market appreciation. This blue icon here, $349 million year-to-date market appreciation that has led to that 2.2 billion in AUM, but still very healthy, $137 million of cash inflows into MSCI-linked ETFs. That's leading to some very positive outcomes for MSCI. If we look at their full year guidance for 2025, we see two important things here. Number one, net cash provided by operating activities. The current guidance is at 1.54 billion to 1.59 billion, up from a low point of 1.525 billion to 1.575 billion. And that's going to have a nice outcome for investors when we look at the free cash flow guidance. So they're actually guiding an increase in free cash flow, now sitting at 1.41 billion to 1.47 billion dollars in free cash flow. So it's good to see positive momentum here for MSCI. Despite not every area of the earnings report looking strong, they still are doing a very good job of sustaining consistent growth, keeping that retention rate high. The market performance this year has allowed them to take in extra cash. And like I said in the outset of the video, they returned that cash to investors via share buybacks. And they just authorized another $3 billion in share buybacks going forward. They're signaling to the market that they're undervalued. Let's see if the valuation, though, agrees with that. The 5-year CAGR for total revenue for MSCI has been at 12.8%. Very good, consistent growth there. My bear estimate has them at 8.6% up to 12.75% on the bull case. So I am being slightly more conservative, at least on the base case, than what their 5-year CAGR is telling us. And we look at the individual growth rates here, we can see index subscriptions, 9% growth in the bear up to 12.8% on the bull case. Total index growth here, their core business, 8.97% growth on the bear case. This is 10-year growth rate, up to 12.6% growth for the bull case. And their ESG and climate. Now, MSCI themselves are very bullish on this segment. Analysts actually are too, and they believe that there's going to be strong growth. In fact, they're projecting long-term double-digit growth in the low to mid-20s for this particular segment. Now, I'm being much more conservative than that right now. I have them at 12.1% on the bear case, up to 18.5% on the bull case. If they start executing this segment in the next few quarters, I might increase my estimates here. But right now, they only grew year over year in this particular segment by 8%. So we need to see some real growth here to have more confidence in their long-term growth and to up these long-term numbers. Either way, strong revenue growth for MSCI over the next 10 years. This is an incredibly high margin business, up there with like the Visas and MasterCards of the world. Operating margin is at 54.2% on the trailing 12 basis. I'm projecting margin growth to go to 56% on the bear case by year 10, up to 60% on the bull case. Free cash flow margin, 45.5% on a trailing 12 basis. I'm projecting that to be 46.1% by year 10 for the bear, up to 55% by year 10 for the bull case. They've scraped that 55% free cash flow margin in one-off quarters here and there. They just need to start sustaining that more regularly. This business is a compounding machine, though. Their free cash flow growth rate on a one-year basis is at 21%. And over the last 10 years, they've grown their free cash flow by 18.5%. It's a very capital light business, so a lot of money available there to return to investors, and they're really starting to do that, not only with their dividend, but share buybacks. We're going to talk about that dividend here in a second. MSCI, like I said, closed the day at $567.54. Hopefully they bounce back today, continuing the momentum they had post-earnings. I think the market did like what they saw out of the earnings. I do believe that this is an undervalued business. The actions that MSCI is taking right now are signaling that it's undervalued. Their PE ratio sits at 36, which is quite below their 5 and 10-year average here. Their forward PE is at 34.4, right in line with their 10-year average and below their 5-year average. And if we do a reverse DCF at that current share price of $567, the market expects a 10-year CAGR for free cash flow growth here at about 9.6% a year. My own base case has them growing at 11.2%. That gives us a bear DCF price here of $491.61, up to a bull DCF price of $833.44. MSCI pays an incredibly good dividend. It's at $7.20 a share. And it's grown very well over the last few years. It grew 16% on a trailing 12 basis. Its 5-year growth rate sits at 20.5%. And their 10-year growth rate's at 42.9%. Now, certainly it's not going to grow at 40% a year over the next 10 years again. But I am projecting the bear growth rate to be at 12% for the dividend and up to 16% for the bull growth rate. And that gives us a bear dividend discount price here of $645.60 up to $917.69 for the bull case. The exit multiple is actually dragging down this valuation summary a little bit here. $476.77, and that's with comps of S&P Global, CME Group, and Intercontinental Exchange. So even if they just execute the way they've been executing and hit their base numbers here, there's some upside here in my view at 11.7%. And if they blow everything out of the water, they really start turning up their growth in the next few years, hit those bull numbers, that's 34.8% growth here. I have a buy price without any margin of safety of $639.86. To me, this is a very safe and reliable business. They have an extra wide economic moat. I've discussed it in detail in prior videos. So with a 10% margin of safety, I have a buy price of $575.87. I actually bought a little bit yesterday myself, so I firmly believe that we are undervalued still on MSCI, and there's a lot of room to grow here. The CEO is signaling growth with insider buying, and the board is signaling growth, authorizing share buybacks. In my view, MSCI is one of the highest quality businesses there is. They're incredibly high margin. They grow consistently. They essentially have guaranteed revenue streams with asset-based fees. Couple that with their strong retention rate for their subscriptions, and MSCI will be a force long into the future.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.